Welcome back. Looking at the market as we get into the last half hour of today's trading session, and the color continues to be red. 1% lower on the bank Nifty. Nifty itself is down by about 0.5%. Nikhil Ranka is joining in this afternoon. He's from Nuvama Asset Management. Nikhil, good to have you on. So it's interesting, the market seems to be now figuring out what the next trigger is going to be, and I think soon enough it's going to be about earnings. Are you expecting any pockets of, upward surprises in Q1?
So good afternoon, Survi, and thanks for having me on the show. Honestly, if you look at it, this quarter could be a watershed quarter in that sense, because if you look at the key sectors in that sense, IT and banking put together will be 55-60% of the total Nifty earnings. In the case of IT, because there was tariff uncertainty in the month of April, a lot of decision making got delayed in that sense. And therefore, if you look at the initial consensus estimates, people are expecting 1.5-2% constant currency growth for Infosys. But if you look for other large cap names like HCL Tech, TCS, TechM, people are expecting constant currency decline. So there will be subdued earnings from IT. And also, if you look at banking, we had almost 75 bips of repo rate cut in the last 3-4 months. And almost 40% of the book is linked to repo rate for most of the large banks in that sense. So, we will see a 15 to 25 bips NIM decline over the next 2 quarters for most of the banking names. And given the fact that loan growth has also slowed down, the system loan growth to close to 10%, the pre-provisioning profit growth will be very, very subdued for banking names. So what we are therefore looking at, the combination of the two put together, is single-digit earnings growth continuing for the next 2 quarters for Nifty names. And the consensus estimates, if you look at it, we ended FY25 at close to 1,010 rupees of EPS, and we are building in closer to 1140, 1150 rupees of EPS for FY26. So if the first 2 quarters are single-digit growth, then the asking rate for the next second half will become more like 16 to 20%, which looks very, very challenging. So my sense is the risk is more on the downgrade side for markets right now. And therefore, the best case is that the markets consolidate at these levels. In our view, the upside is probably single-digit from these levels in Nifty over the next 6 to 9 months.
Okay, so best case is markets consolidate and see a single-digit kind of an up move. But what is the base case then, Nikhil? If we do see those earnings downgrades in the second half of the year, because consensus is still running a little high, what could be the extent of downgrades and even the extent of downside, say, on the index? Because some of the factors that you spoke about, say for banks, the NIM compression in H1, or the fact that system loan growth has slowed down is well documented. We've been talking about it. So isn't that not already in the price?
So Rima, if you look at it, we are right now at a number of closer to 1,300 rupees of FY27. And if you look at the last 8-10 year trading band of index, 19 to 20 times is the medium trading range of markets. So, even if we take 0 downgrades to earnings at 1,300 rupees of EPS, 26,200 becomes the upper end of the trading range. Now, if I'm building a 2-3% earnings downgrade to the 1,300 rupees of EPS that we are currently factoring in, and if we end up close to 1,250 rupees of EPS, then given the fact that you will have earnings downgrade, so, there could be lower multiples that could get assigned to market. You could probably have some sort of sell-off till 24,700, 24,800 levels. And then, probably we start building in FY28, 6-9 months down the line. And then the next leg of up move will come in. But right now, my sense is closer to 26,000 odd levels. A lot of positives start getting built in for the markets.
Okay, all right. Hi, Nikhil. Good to see you in. What about the pharma pack? It appeared to be a bit of making a comeback, but you're saying the second half of the year will be challenging. Tell us more.
So Nigel, if you look at it for most of the large cap pharma names where there was a US exposure, combined put together, Indian pharma companies would have done close to $1 billion of revenue from one single drug, which is Revlimid. Now, Revlimid goes off patent in Jan 2026, and a lot of the supply chain over there will start doing destocking from Q3 onwards. So whatever is the number that has to come will come in Q1, Q2, and then for the second half, there will be a very big void if you look at names like Dr. Reddy or Cadila, because they had very chunky contribution from Revlimid in their US earnings. So therefore, my sense is till the time we have some visibility of any other blockbuster drug from these companies, it's going to see earnings decline in FY26 and 27 for these names. At best, it could be a flattish EPS. And therefore, these stocks could have significant time correction from these levels. And therefore, I don't think, you can have even double-digit upside in these names from the current levels.
Nikhil, so given your cautious stance on the market, and of course, we're all awaiting to see if there's indeed that earnings recovery, what is it that you would advise taking exposure to right now? What would be, say, your top 2-3 themes or ideas?
So if you look at it, telecom is one of the most defensive bets right now. If you look at it, we had a tariff hike 6-9 months back. A large part of that has got absorbed in the numbers. And my sense is, before we have a Jio IPO somewhere in second half of this financial year, there could be one more round of tariff hikes that might get contemplated. So if we have another tariff hike of say 15 to 20%, and if you look at the flow through to EBITDA, it's almost 70% that flows from revenue to EBITDA for telecom names, the incremental part of it in that sense. And IT is in that sense insulated from growth from a lot of the global turmoil in that sense. We don't know what will happen on 9 July when the tariffs finally get announced. But telecom is one sector which will be completely insulated even if there is some volatility around 9th of July in that sense. That is one space where I think there could still be double-digit returns that can be made over the next 12 months. So we are positive on telecom from the current levels.
IT in particular, Nikhil, I know you look at it very closely, which is why we ask you every time. But any stocks we should watch going into the earnings season where there is a mismatch versus expectations and what the company might deliver? From an earnings point of view, the stocks which are on your watch list from the tech SPAC.
So, Rima, I think Coforge is something that could prove out to be very interesting. If you look at the commentary of Q4 also, the management was extremely confident that in spite of the uncertainty that they are seeing in Q4, they will continue to see very strong growth. And given the fact that they have sold one of the loss-making subsidiaries, margin expansion should also come through for Coforge. If you look at the initial estimates with some of the brokers have put through, people are expecting close to 7% CC growth for Coforge this quarter. So if you juxtapose that with the rest of the pack where, you are either seeing a decline or 1.5% growth, and you have something which will probably grow at 7%, then obviously multiples will start getting re-rated for those things. So I think that is one of the interesting names which should be looked for in the current earnings season.
Okay. All right, Nikhil, we'll wind it up on that note for today. Thank you very much for joining in. Good to get that perspective on the market with you. Thanks for that. Thank you. Well, let's move on.